Peter Lynch was a fund manager at Fidelity Investments between 1977 and 1990. During this time, Peter averaged a 29.2% annual return, consistently more than double the S&P 500 stock market index and making it the best performing mutual fund in the world. He is a truly amazing investor, and just like Warren Buffett, he likes to keep things simple and drown out the noise in the market. So today, I want to share with all of you what this legendary investor has to say about how we should handle both stocks and the overall market volatility.
A lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100, people said, here's this great company, great record. If it ever gets below 100, just buy every share, and it did get below 100. A lot of people bought on that basis saying, look, it's gone from 135 to 100. It's now 95, what a buy. Within a year, it was 18. And this is a company with no debt. I mean, this is a company, it was just so overpriced, it went down. I did the same thing in my, I think my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now I'm fortunate this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. So I was able to, it was compressed. And at 3, I figured out, there's something very wrong here because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now I learned this very early, this might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky, some people can approach that, it's a real achievement, but they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel, they sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? Psychiatrists haven't worked so far. I've never seen them running in. The psychological psychiatry fund I've never seen listed for with the SEC to make it through as a mutual fund. So they haven't seemed to help. I've tried prayer. That hasn't worked. So if you don't understand the company, you have this problem when they go down.
Okay, so the first point that Peter says is that we never know how low stocks can go. So to buy a stock only because the shares have fallen is a losing strategy. Sometimes you find a stock that you think is a great deal at $16 a share, and then in Peter's case, the stock continues dropping all the way down to $3. The thing is, if you love the company at $16 a share and nothing with the fundamentals have changed at all, then $3 a share should be an absolute steal. In Peter's case, he purchased Kaiser Industries, and as he said, after he purchased, the stock price just kept going down and down and down and just kept on tanking on him. However, Peter continued looking and paying attention to the fundamentals of the business, and he realized that everything with the business was actually okay. So since he thought that everything with the underlying fundamentals of the business was okay, that everything would work out just fine. And eventually, Kaiser Industries ended up giving out shares of all of their subsidiaries, and this amounted to a total of about $50 a share, which means that Peter ended up doubling his money on this investment. So in Peter's case, this was nothing more than the market being irrational, and not really focusing on the fundamentals of Kaiser Industries. If you know that the fundamentals of the businesses that you own are strong, then you should also know that there is no reason to panic or worry when the shares of those businesses drop. Which also leads me very nicely to the next point. And this point is, know what you own and why you bought it. Now, I personally think that this point right here is one of the most important points in all of investing. So let's talk about Peter's Kaiser Industries investment once again. Peter says that if you were someone who ended up purchasing Kaiser at $16 a share only because the shares dropped from $24 a share, then what are you going to do when, the stock hits $8 a share or $4 a share? You're most likely not going to hold through a drop like that, because the reason you own the shares in the first place is because you thought the stock could not go lower. So many people in the market do this too, where they go and they buy something they do not understand and have done very little research on. This causes people to become very emotional with the stocks they hold, and ultimately causes them to sell their stocks when they end up dropping because they have no idea why they own them in the first place. You have to know what you own and why you own it, because if you don't, then you're going to have no idea what to do when the stock drops on you. In reality, these dips that wonderful companies' shares see are usually opportunities to buy them while they're cheap. If, however, you don't know that you own a wonderful business and you're just investing in this business for no reason, then when the stock drops, you're not going to know to increase your position or that the stock dropping is actually an opportunity to buy more. And you'll probably just end up selling out of your position in this wonderful business for no other reason than the stock is currently in a dip. Now, here's the thing. Every single stock in the market is at some point going to see a decline to its share price. Stocks do not go up forever, and these dips that these shares see are actually opportunities for someone who knows what they own and are looking to invest in that business for the long term. So what I would personally recommend is going and taking a look at your own personal portfolio and asking yourself on every single stock, do you know why you own it? Like, what is the reason for that stock in particular to be in your portfolio in the first place? Can you also explain to me in under 2 minutes what that business does, is it a great company, and if the fundamentals are okay? If not, then it's probably time to do some additional research on the stocks you own, because if the market ends up making these shares go down, then you're probably going to get quite emotional and fearful because you don't really know what's in your portfolio. Also, once you start taking a look at the fundamentals of the stocks you own, then you may start noticing that there's some stocks that shouldn't be in your portfolio in the first place. But anyways, let's hear more about what Peter Lynch himself has to say about all of this.
I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports, they buy a microwave oven, they do that. They ask people what's the best kind of radar range or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet. And that's what you get for it. And that's what we were being driven to. And it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market.
First off, Peter is saying that a lot of people in the market go out and buy stocks with very little research simply because they heard the stock is a good one or that it is going to go to the moon. And he's saying that long term, this is not a winning investment strategy. Now yes, sometimes we buy a stock we don't know very much about and the shares just end up going up like crazy. And I actually think that this has been happening a lot more in the last year. However, long-term buying stocks we know very little about or haven't done very much research on, I don't think is going to work. Like, yes, it seems to be working right now, but I don't think that this is going to last forever. And to be honest, I would be absolutely shocked if a lot of the stocks that have been running in the past year are still going to be this high in the next 3. There's actually a quote directly from The Intelligent Investor that explains this, and it's one of my favorite quotes of all time. And the quote is, "In the short run, the market is a voting machine, and in the long run, it is a weighing machine." What this means is that in the short term, investors pour money into a stock and shoot it up like crazy, producing very quick and high returns because they're voting that this company is a winner. However, in the long run, if that company does not go on to do well or live up to its current expectations, then the stock will end up dropping. So again, knowing what you own and knowing that you own a fundamentally strong company will help you avoid the losers and pick the long-term winners, while at the same time ignoring all of the noise in the market. Now, the next point says that there is a reason that stocks go up. To explain this example, Peter uses Coca-Cola, and he says that the shares of Coca-Cola have increased by about 30 times, while at the same time, the earnings for the company have also increased by about 30 times. So essentially, what he is trying to say is that as the earnings of Coca-Cola as a business increased, so did Coca-Cola's share price. He also says that another company is not earning as much as they once were in the past, and today, those shares are now selling for about half of the value. What he is trying to say is that stocks go up or down because the underlying business does better or worse in the future. He's trying to say that stocks are not lottery tickets, and there is a reason they go up, and that these random stocks are not going to just continue going up and up and up over the long term for no reason. To put it simply, the stock will continue going up over the long term if the underlying business continues doing well. And also, when we invest in stocks, we are actually investing in a real business. There's actually another quote from The Intelligent Investor that explains this, and it says, "Stocks do well or poorly in the future because the business behind them does well or poorly. Nothing more and nothing less." Alright, and before we move on to the next point, I just have to say that my cat decided to join me. He's been clawing at the door. So, this is Tuna. He's gonna be with us for the rest of the video, I guess. Oh, you're so funny, dude. But anyways, the next point that I want to make is that there is a business behind every stock. Every single stock on the market is attached to a real business, which means that when we're buying stocks, we are actually buying a very small ownership into these companies. These businesses that we're investing in through the stock market have real tangible value. And as these businesses go on to grow, investors are willing to pay more for a small ownership of them. This is essentially how us as investors make profit, is by investing into a company and then having that company grow over a long period of time, and then investors are willing to pay more for your shares in the future. It's not magic, everyone, and long term, the underlying fundamentals of the business growing are the only thing that will sustainably grow a company's stock price. But now, moving on to the final point. This one is, do not try to predict the market. Peter himself, who is an absolute legend of investing, says that no one can predict the stock market, and trying to predict the stock market is a total waste of time. This is 100% true, and I personally have no idea what the market is going to throw at us in 2021 and beyond. So, if it is pointless for us to try and predict the stock market, then what should we do? Well, we should focus on the one thing that we can do, which is trying to find and invest in fundamentally strong businesses that we think are going to grow over the long term, and hold them for the long term. The market is very volatile, and the stocks that we own, no matter how fundamentally strong they are going to drop on us from time to time, and there's no sense trying to predict when this is going to happen. Let's now hear what Peter Lynch himself has to say about market volatility and if us as investors should be scared of it.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola, and I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will fall. That's all there is to it.
Peter himself says that he loves volatility because volatility is what creates opportunity. He also says that there is always going to be something that comes from out of nowhere, hits the market by surprise, and causes stocks to drop and create volatility in the market. We actually saw this exact thing happen last year in 2020, when the virus made its way over to North America and sent stocks into an absolute freefall. When these events occur, they send stocks down extremely quickly, and Peter is trying his best to tell us that when these events do occur, that they are just opportunities for us to buy our favorite companies at an extreme discount. And again, this is 100% true. I mean, just take a look at how far the market has come since the drop in 2020 and how many gains everyone is currently sitting on. These major dips, corrections, crashes in the market are very scary in the moment, but long term, this is where the best opportunities are presented. Which also brings me very nicely to the next point, which is volatility will occur, and this is what creates opportunity. Peter is basically saying that volatility is a for sure guaranteed thing in the market, and it's going to come again and again and again and again. And once again, he is saying that all of this volatility is what gives us as investors opportunity, so long as we know what we own and we are not scared to buy these stocks when they are dipping. The market is going to be silly, and it's going to price some things that are fundamentally strong very cheap, and this is nothing to worry about, so long as the business is still okay and fundamentally strong. Just look at Peter's own Taco Bell example. He bought Taco Bell at $7 a share, and it went all the way down to $1 a share on him, and he never sold. And Peter never sold Taco Bell because Taco Bell had no debt, and people were still eating at the restaurant, so the company was still fundamentally strong. A few years later, Taco Bell got acquired by Pepsi for about $42 a share, which means that Peter made over 500% on his position by holding through the volatility and taking advantage of it. He then says that the next 3,800 points in the stock market, or essentially the next double, should happen within the next 8 or 9 years, but the next 500 points, he has no idea if they're going to be up or down. What this tells us is that long term, the market should continue going up, just like it historically has after every single drop. So, if the market does drop 10, 20, 30%, then we can bank on this being a short-term event that we can capitalize on over the long term. Essentially, all of the volatility that we see in the market is just creating opportunity for long-term investors. And this is what we should see all of these stock market drops, corrections, and crashes as. We shouldn't fear volatility or the market dropping, and instead, we should view volatility as an opportunity. So to wrap this all up, let's just hear from Peter one last time.
All you have to know is you're going to see, it's always going to be scary, there's going to be always something to worry about, and you just have to forget all about it, cut it all out, and own good companies, or own turnarounds, study them, and you'll do well. And that's all there is, and I'm ready for questions.
In the stock market and in the economy, there is always going to be something to worry about, and it is always going to be scary. Us as long-term investors need to drown out all of this noise, and we need to forget about all of the negative headlines and all of it. And what we need to do instead is focus on investing in wonderful businesses with incredibly strong fundamentals for the long term, and that's all there is to it. But that's pretty much going to wrap up the video, everyone. And if you enjoyed this video or you found it helpful in some way during all of the stock market craziness that we're seeing right now, then please remember to leave a like on the video. Leaving a like on the video really helps out my channel, and I really appreciate it. Also, if you want to stick around to see more stock market related content just like this, then please consider subscribing to my channel as well. With all that being said, thank you all so much for watching, and I truly hope to see you all again in my next one.